hosting this panel on the broader M&A outlook for 2022, and we're obviously in very unique times. Just by way of background, Sam Shah, I'm a Senior Managing Director. I co-head Macquarie Capital in the US and then lead our software franchise globally. Please be joined by Roger, Kevin, and Justin, and I'll let them introduce themselves here in a second. But the topic for discussion today is obviously, M&A outlook. Obviously, a lot of volatility in the market, over the last several weeks and months, and just getting kind of a direct view from obviously some leading investors and minds, in tech. So with that, maybe Roger, go down the line.
Sure. Roger Premo. I lead strategy and M&A for IBM, and so I oversee both kind of our overall larger acquisitions, but I also oversee our kind of corporate venture arm as well.
Great. I'm Kevin Bhatt, Managing Partner at Long Ridge Equity Partners, which is a growth-focused private equity firm in New York. We focus in the financial technology and business technology verticals with a heavy emphasis around bootstrapped, founder-led companies.
Justin Sadrian, I'm a partner at Warburg, Pincus. Warburg's one of the largest and oldest private equity firms. We've been around for 60 years. We've got $75 billion under management. Our roots are in venture investing. We are stage agnostic. We'll invest anywhere across the company's life cycle. Roughly half of our investments are minority, half are majority, half of our money is outside of the US, half in the US. We're partners with management who are trying to build enduring businesses that outlast our involvement.
Great, thank you. And maybe actually, Justin, given sort of Warburg's global purview, given obviously the broader geopolitical climate, how has Warburg, and maybe I'll go down the line here, but start with you, Justin. How has the geopolitical climate impacted sort of broader views around tech? More generally, we hear about discussions about 30, 40, 50% corrections in some instances in tech valuations. How has Warburg been looking at the market in that context?
Well, it's certainly been an exciting time for all of us. For us, we're very much open for business. We've got $18 billion of uncalled capital. And frankly, I think this is an incredibly exciting time to be an investor. In particular, for us, we're fundamentally driven as opposed to momentum-driven investors. And I think that kind of market, this kind of market suits us well. We're very focused at this point in time around, first principles of investing. So at this point, we're looking for companies that, are only of the highest quality, businesses that are leaders in their market, dominant players in their market. We're focused on growth businesses. Our growth portfolio on the tech side, I think the average company is growing 40%. We've got plenty that are growing 50 to 100%. On our larger scale growth buyout tech practice, the average company is growing north of 25%. And then I think most importantly, we're focused on companies that have sound unit economics. And I think this is the thing that's going to really make a difference at this point in time in this kind of market. For one, it's about profitability. We hear that in the public markets. That's where they've been focused. For us, we don't mind investing in unprofitable businesses as long as they have sound underlying unit economics. And that means, they're very retentive businesses, high net and gross retention rates. It gets at need to have versus nice to have. We're also looking for companies with very high sales efficiency or quick payback on a dollar invested in acquiring a new customer. This is important because in quick payback businesses, today's customer is going to finance tomorrow's new customer, as opposed to some external equity capital, which is much more expensive and dilutive. And quick payback businesses have much higher out-year potential EBITDA margin than folks that take longer to pay back. And so that's been a big focus area for us. But for those kind of fundamentals first, businesses, we think it's an exciting time to be investing at, frankly, more reasonable valuations.
Yeah, I'd echo those thoughts. It's certainly a tumultuous time, but one that I think we look at as being pretty rich with opportunity. We are, much like Justin's firm, focused on growth. So our companies, on average last year, grew over 60%, and in almost all cases, profitably. So we really look for a lot of the same tenets that Justin laid out around really favorable, enduring unit economics. Growth at all costs, I think, is very much a thing of the past, and not just private equity investors, but strategic investors in public markets increasingly focused on, what that out-year EBITDA margin can really be at scale. And that's an intellectually honest discussion that we have in our investment committee all the time. So, as we think about where the world is today and some of the, kind of repricing of various business models, we think it actually makes for an environment where our capital and the capital that comes from maybe all of us on this stage will have a better chance of overlapping with seller expectations than maybe it did in 2021 when that was not always the case. So as we think about, sort of this market and what is to come, maybe Q2 is a difficult time as we all try to figure out what, kind of true value is and what are we multiplying and by what multiplier. But once that does equilibrate, I know that from our perspective, with a large pool of dry capital and a lot of conviction around the underlying trends that drive, sustainable enterprise value in our spaces, it's a pretty exciting time to be meeting entrepreneurs. And I think we'll talk a little bit later on around some of the drivers that are still creating a ton of tailwind for innovative technology companies that can solve big problems for businesses and consumers.
I'd say, from our perspective at IBM as a strategic acquirer and operator, I think, I make a few comments. I think one thing that we've had to deal with, the reality is that we've discontinued operations in Russia, and we're doing a lot of work to really understand, are there other dominoes to fall, and how do we replan our business to be ready for that? If I think of IBM as an acquirer, right? So, we're very clear on our strategy, and for people that haven't paid attention to IBM in a while, when we acquired Red Hat, it really was this premise on technology is heterogeneous, it'll exist in various clouds, it'll exist at the edge, and open source software gives us a common platform so you can innovate in the same way regardless of where that technology happens to run. And so that core thesis and investing around that is still our focus overall. We definitely see that prices have come down and a lot more is in our strike zone. And so we're doing a lot of work. It's a pretty active time. And I think we are now starting to see emerging kind of precedent transactions that help set a market price so we can actually say whether or not boards and founders will actually accept some of those prices. So I think, Anaplan and Thoma Bravo, this week's, if all true, this week's announcements around Broadcom and VMware kind of set the price at last year's kind of 52-week high is roughly the purchase price things will transact at. And then I think if at the smaller side of acquisitions, I think we, again, not to throw in too many IBM advertisements, but a different profile of business where, over the last several months, we've actually been up 10% versus a peer set that's been down 20 or 30%, depending on how you look at it. And so when we look at ourselves as an acquirer, we look a little bit more like a safe harbor. And that's driven a lot of interest for companies that have perhaps a great piece of technology, but earlier on that product market fit or kind of unit economics. So they may be concerned about weathering a recessionary environment and they're looking for a safe harbor. So we think that, based on some real experience, like we're seeing a lot more interest and we're seeing a broader strike zone to participate in.
And speaking of, maybe to ask a more provocative question in light of, the commentary around last year's 52-week high, sort of setting the bar, if you will. I think the issue du jour or topic du jour, has been that given the rising rate environment and, some of the empirical correlation to the downdraft in tech valuations in particular, there's this raging debate about, is this reset in valuation more permanent or more temporary? How do you guys, maybe Roger, starting back with you, how do you think about that? And, we're going to record, it's recorded, so.
Should I say what I want it to be or what I think? I think we're going to, my personal opinion is that, we're going to be facing a real recessionary environment, so we have to be adjusted to the prices that may endure for a period of time here. I think over time, actually a lot of the valuations in the market weren't irrational. They're based on fundamentals, but an expectation of a growing economy that was consuming more technology as a percentage of GDP. I think as we weather this storm, we'll return, personal opinion, but I'm not I'd love to hear from the rest. I think we'll return to something that reflects that. And I think, you see categories like cybersecurity where the valuations haven't really come down because the underlying demand signal, which, on other businesses, the demand is like the total budget of the company that would purchase that technology. The demand signal in cybersecurity is the amount of threats and growth of that. And when you see that demand signal continuing in the market in the cyberspace, you see valuations pretty stable there. So I think the market's rational and it's basically pricing in the recessionary environment that we see coming.
Yeah.
Yeah, I'd agree. I think that the outlook over the next, 3 to 6 months looks pretty choppy, and certainly none of us have crystal balls, but it's a cloudier horizon than maybe it was, 4 or 5 months ago. With that said, as we think about valuation, what we see happening is more of a bifurcation where a lot of the business models that actually just didn't make economic sense, those valuations will never come back. So some of the, sort of uneconomic consumer-facing distribution plays across, financial and business technology, just it might not happen again. Whereas a lot of the sustainable businesses that are driving, profitable or, sort of unit economic positive growth on the back of persistent secular tailwinds, like, as Roger's saying, the need for cybersecurity services and software in the face of increasing state-sponsored terrorism, cyber terrorism. Those are persistent growth drivers that will create a new generation of leading companies with really attractive valuations. So, there's probably a bit of a bifurcated answer where some of these companies, those valuations were incorrect and they will not come back, but others, on the tail of some strong growth and some proof of concept around profitability, very much might exceed where they were in the past.
Yeah, I think IBM was playing less in the consumer plays that you're describing, so that's a good add.
It never feels good when you watch the market and it goes down every day, but I think, we'd argue that over time, it's maybe a healthy thing. So it's also not surprising, if you look at the folks at this conference, I bet way less than half of the people here have ever worked in a recessionary environment or worked through a bear market. And I bet you less than, 15% have worked through two. We're working here back in 2000, 2001. So it's inherently uncomfortable. And I get that, but I think it's a good thing. I think the market is going to become, or already has become, a lot more discerning. And you see it in the public markets. We've got a grid that tracks, the growth rates, different stages, 10, 20, 20, 30, and then the profitability. And surprise, surprise, it's the ones that are the most unprofitable that are the ones that have gotten hit the hardest, or the ones that haven't proven out their very business model or the unit economics, the faux tech companies, that are masquerading as tech companies, and they really aren't. And I think there'll be a real shakeout on that front, but I don't think that's a bad thing. The other thing I think that it will be positive going through some of this choppiness is we'll emerge from it with greater alignment. If you're going to sell your company and the investors and management are all going to sell out 100%, then sure, top dollar's all that matters. But if you're looking to do a minority growth investment or a minority recap, or as management, you're trying to take some chips off the table, that valuation is just a moment in time. And when you get these crazy valuations that, aren't justified by the underlying fundamentals, you end up with really uncomfortable boardroom dynamics where, the early guys are in sitting on a huge win. The late guys are in at a massive valuation, but they have preference. And then you got management, stuck in the middle. And I think you'll come out of this, and frankly, it's my advice to folks is, find a valuation that works for everyone so that you can focus on making, business decisions with the best interests of the company, over the long run in mind, as opposed to, trying to play, the cap table.
Switching gears for a second, and actually, Justin, you sort of set it up pretty nicely. Is one thing that's become quite prevalent just in the capital markets more generally is the role of the private market, whether it's private equity and raising 25, 30, $35 billion funds now, or even the role of the private debt players in the market, what the corresponding impact is to companies accessing the public markets. For growth companies, maybe some in your portfolio, some that you're pursuing, how has your view changed about whether a company is ready for the public markets? That seems like the threshold for size seems to be ticking up further and further and further for relevance in the public market. But, given that kind of backdrop of, the private markets, how much capital is there, the timing, of when is right to go public, in your view for a growth company, when is the right time to, be a public company? And in your view, is the public company exit the right exit?
So, look, I've had 3 of my companies go public in the last few years, and in each of the cases, I've said I'd always rather look back and say, oh, geez, we could have gone public a quarter or 2 earlier than we did, than to ever get in the situation where you look back and say, oh, shit, we went too early. Because you you get one shot at it, and if you stub your toe in the public markets, then you go into public company purgatory. The marquee investors that you're trying to attract, not only to invest into your IPO, but to build $100, $200 million positions over the long run, are going to flee, or you're never going to get big enough for them to build a big enough position. The equity analysts will start to lose interest, and then it's just really hard to dig your way out of it. And as we harp with our companies, we've taken 150 some companies public. We say an IPO is a financing event. It's not a liquidity event. It's a moment in time. It's a fun, exciting, ring the bell kind of moment, but it's just one day. And so with that, and the management and the CEO and CFO in particular's job changes dramatically. They go from only focusing on building my business and maybe keeping my board happy to having to spend a quarter or a third of their time talking to public investors who are primarily focused on, are you going to hit your quarter? So that dynamic changes. So with that as a backdrop, and admittedly, I've got a dog in this hunt, we encourage our companies to stay public as long as they can. You can think about and make investments with a very long-term horizon. You can manage through a J-curve. You can focus on unit economics instead of profitability. You can be strategic. You can, take bets that are a lot easier to do in the private markets than they are in the public.
Yeah. I would agree. I think, we had 2 public companies over the last 4 years that were subsequently acquired, and 1 company that was in the process of going public in Q1 this year and put that on hold. And our views on IPOs are maybe a little bit different from, sort of conventional wisdom, just given the scale of some of the companies involved. The depth of private capital markets today has meant that it takes, it's a very special set of circumstances that require an IPO. There are very few things that can't be done in the private markets these days, that require the true depth of capital available in the public markets. So we've been pretty, sort of cautious around encouraging our companies to pursue public offerings. And what we found more often than not is that it ends up being a personal decision on the part of the CEO, their specific temperament and the scale of their ambition. And if somebody desperately wants to go public, we've counseled and tried to support. But if they don't have that particular ambition, we believe that you can accomplish almost everything that you want to do in the private markets with a longer-term investment horizon, less scrutiny on the near-term, moves that you make, and a lot more flexibility around, some of the things that create long-term value maybe 3-4 years down the line. So I'd say that, that picture was maybe a little different in 2021 when the public market valuations were in excess of even where the privates were. But, those things come into focus and probably are back in shape.
And I know, Roger, your lens might be a little bit, different in this respect, but, frankly, given IBM's lens of how they actually look at, certain public company situations, whether it's M&A targets or benchmarks, when do you think the right time is to sort of wade into a situation versus, frankly, letting the market kind of correct?
Listen, we're having conversations, and it's about what is the price that we can transact at. And I think it depends, a lot of it depends on the category and whether or not there is a correction in that category. I think a lot of it has to do with the timing of when the last funding event was and the economics of that business. So I think it's going to be very situational. From our perspective, we want to be having some of those conversations so we can explore them. But a lot of them end up in a situation where the valuation that a board or a founder has their eye on is just incompatible with prices in the market right now.
Yeah, and that's actually, just to kind of play on that a little bit, I mean, we still, and we see it in our own deals, like this whole notion of the bid-ask spread on where people sort of think, the value is versus, how it resets. If there's sort of a set of factors in your mind where the mea culpa event happens, what do you think? What do you think some of those are? Is it just sort of, persistent sort of headwinds in the market, or we've heard, frankly, in some contexts, the SPAC market has been a point of capitulation, down rounds been the point of capitulation. What are the kind of factors at least you all might look for, in sort of solving the bid-ask spread? And maybe, Kevin, start with you there.
I think you named a bunch of them. One observation that we'd offer is that public market valuations adjust much more rapidly than private valuations do. And, we're transacting typically with highly concentrated shareholder bases who very often, I know speaking from our own experience, what you think your company is worth doesn't go down quite as quickly as it goes up. And it can be hard to find overlap. But that's actually one of the great things about private market transactions and the flexibility and the breadth of structuring opportunities out there. So one of the things that we've been exploring lately is trying to think about, look, we do minority deals, we do majority deals, and a lot of our transactions in this transitional market have structure on them, where we're thinking, look, it's possible that the right price is X, it's possible the right price is 1.5 times X. We all want to partner now and put the right resources behind this company to help it grow through this market. Let's punt on valuation and let the performance of the business be a bit of a beacon to make that determination down the line. So I think that there are a lot of things that we can do in the private markets that are actually pretty interesting vis-a-vis putting a single per share price on a public company that you're trying to acquire.
It does still feel like there's a delta. I had to chuckle. We were hearing from an LP who was reporting or talking about their investment in one of the crossover funds. And they said, well, the public book's gotten creamed, but fortunately the private book's held up really well. Kind of like, So, for us, for the real high quality businesses, as sellers, we were happy with the valuations we got all the way through 21, and I'd say through and into the first quarter of 22. These are for your market-leading A+, with growth and durability and capital efficiency. Those, I think, there's still a pretty decent bid for. If you move down the quality scale, it's gotten squirrely already. I think what we might end up all seeing is just less transaction volume. That anyone who had a good business and an ambitious growth plan has been out raising way ahead of their business plan, which is the right thing to do. And I think with folks having cash socked away, they'll just sit for a while unless they need to do something. And maybe that's not the worst thing in the world. We'll see.
I want to go back to something we're sort of tangentially touching on, Justin, which is, look, in the midst of the Great Resignation, talent has coming at such a premium now. Talent acquisition, talent retention, sort of name it. It feels like at this time more than any other in the past, at least what we're seeing is the acquisition of talent is almost at the top of the list alongside, the acquisition of revenue, the acquisition of product. How much do you all, and maybe Roger, starting with you, how much do you all weigh that? And, how are you sort of thinking about talent acquisition in the midst of this market that's become so transient?
Listen, it's a top priority. It's something we talk about as a leadership team on a regular basis. I'd say actually that there's early indications that some of that talent market is becoming more accessible than it was just a couple of months ago. And you see things like Facebook pausing hiring and things like that. So we're seeing, I think, indications that it's becoming a little bit less of a bidding war for some of that talent than it was maybe just a couple of months ago. But it's a fundamental, it's a critical determinant for our business. And I wish I had a great answer for it, but one of my main things is to just actually chunk out time on my calendar. So I'm having conversations with a pipeline of talent that I can have, and I'm advising other folks to do the same, so that they're always, when you have the need for the talent, it's not starting from square one. It's a pipeline that you've already built. And so that's something that we're doing across our business to make sure that if there's a market correction or the startup they're at goes sideways, the talent that we want is closer to IBM than it would be to one of our competitors.
Yeah. I'll just give an anecdotal piece of information, which is we just finished all the Q1 board meetings across the portfolio, and all of our companies report churn across the employee base. And after just a brutal 2021, Q1 was really quiet. And feels like if, we can all speculate as to the drivers, but Q1 from a voluntary churn perspective was wildly different from any quarter we saw in 2021. So does that feel like that's the beginning of an easier period from a talent retention, talent acquisition perspective? Maybe.
Look, people's the most compounding asset that any of us have in our businesses. And we've tried to focus on, the top of that, the true A players, because they will go out and hire other A players. They help solve really complicated problems and can move on to the next one. So for us, it's about, there's been a lot of focus on the high pos, the high potential folks, investing in them so that they can rise up within a given company or maybe even move across the portfolio. But just having them feel the love. We find that oftentimes, while comp is the issue at the end, it isn't the reason why they picked up the phone in the first place. And so to try and, nip that in the bud to make sure they're feeling invested in, I think is important. And then the only other I'd agree with both these guys about, it feels like it's gotten a little bit easier over the last few months.
Interesting. Well, look, I think kind of maybe one of the last or the last question here, and again, appreciate all of your views on this, which is, given kind of some of the geopolitical conflicts, that are arising in the world, there is this feeling of, while we've experienced sort of globalization or trend towards globalization, over the last sort of 100 years, we might be on the precipice of deglobalization, where for national security reasons or whatever, the issues may be, that there is going to be this more nationalistic view, and that will start with intellectual property, with tech. Obviously, Justin, maybe starting with you, given that Warburg has such a global remit, how do you think about that? Do you think that there is a new world order emerging in some respects that you have to be mindful of, maybe even if it's at the surface? Or, do you see this sort of as a blip on the radar, in terms of that?
Yeah, we do see it, and I would expect it to continue. I think, unfortunately, for all of us, we'll see what happens, next year and in a few years. But to be honest, we're more focused on, again, back to the fundamental investing about building a great business in a category that's growing. And so the geopolitical overlay tends to be, less of a driving force in our investment theses. Take Russia. We have no end market exposure to Russia. We have no employees in any of our companies in Russia. We have some developers in the Ukraine and spent a bunch of time trying to get them and their families out of the Ukraine. But for most of our investing, certainly in the U.S. and Europe, it's not much of an issue. We've got a big practice in China, but the practice in China is all about domestic consumption. So it's not relying on the U.S. or external markets to fuel the demand of those businesses. I think that would be a little tricky.
And it's even in the context of things like supply chain, et cetera. Just everything feels like it's gotten so much more complicated, over the last sort of year or two, and so it's kind of in that context.
Yeah, the supply chain stuff. Look, we've been big investors around supply chain for the last couple of decades. It's around the digitization and increased transparency, managing a more dynamic supply chain, and then along comes COVID, where there we are hunkered down, and everyone moves from buying services to buying goods. We get about 10 years worth of e-commerce acceleration in a quarter, and we get 3 rounds of stimulus, to throw into it all. Add in like the Suez Canal and shutdowns in China, and you got a total mess. You've got these pileups in the Port of Long Beach. You got trucks that we have a huge dearth of. You got no workers at warehouses, and so we've been investing in and around that. We've got a few interesting investments. Cargomatic, focused on what's coming into the ports and being a matchmaker. Blue Grace Logistics is helping matchmake on the trucking side, and then Softion is helping out with the warehouses and helping warehouses manage their businesses more efficiently, all of which are growing 50 to 100% through COVID. And even after, the COVID bumps aside, I think are going to be, great businesses.
Yeah, the geopolitical uncertainty is amplifying a bunch of trends that we've been invested behind for a long time. So for the last 10 or 12 years, we've had a pretty significant portfolio in risk and regulatory software. And it's interesting, a lot of that has been driven by a broad view that fragmentation of regulatory regimes, increased oversight by multiple, sort of bodies from most multinational companies, has created a really difficult to manage, kind of spaghetti for most companies across sectors. And so we've made a bunch of different investments across those trends. And what we've been surprised by is that, the sort of geopolitical risk is not something we ever underwrote as a meaningful factor. But for companies across across the world and across sectors, it's become something that every C-suite has to manage today. So we have a couple companies that are helping manage those risks. We have a business called Oratain, which is the leading provider of raw material origin data to manufacturers across the world. So they use radioisotope data. This is the actual technology and the vendor that Customs and Border Protection is using to prove that garment manufacturers don't have Western China source cotton, or that sort of raw material inputs into pharmaceuticals are from the regions they said they're from. That's something that was important before, but as geopolitical sort of tensions heightened, it's something that, companies that were never focused on this are today. So it's an interesting dynamic. And then the issues around supply chain, fully agreed. It's the globalization, the just-in-time, is that pulling back a little bit? Are people focused on that risk in their supply chain? And hopefully for companies that we back, using software solutions to solve those problems? We believe the answer is yes, and we think that the investment around those things is going to be pretty significant over the next couple of years as it's got a real impact on the bottom line.
Pretty similar view, more from kind of a technology portfolio perspective, but the places where we invested, like I said, hybrid cloud, data and AI around that, cybersecurity, process automation around that, we see all of these kind of tailwinds on that. So I think the geopolitical risk is real. I think we are seeing an east-west front on technology vendors, clouds, et cetera, and I think there'll be interesting markets if it's Indonesia or Malaysia to see where they tip east or west as some of these lines are drawn. But I think from that thesis of our strategy, where it's premised on the heterogeneity of technology and delivering kind of open source software on top of that, I think the increased kind of if it's sovereign clouds, data regulations, east-west splits, that just is a tailwind on that heterogeneity. So it kind of amplifies what we've been doing in our strategy for a while, and we're continuing to. They're just tailwinds on the investment areas that we've been looking at for a while. So
Fully agree.
It's none of our jobs are boring. It's an interesting time.
Well, I know we got a little bit of time left. Wanted to give the audience the opportunity to ask any questions, but thank you for the thoughtful responses thus far. Okay, well, thank you again, gentlemen. Very, very thoughtful. No surprise, but appreciate the time. Thank you, everyone.
Thank you.